This week on the vlog, we're talking about the economic indicators. These are the things that let you know what's going on. So this week on the vlog, we're going to focus into the economic cycle. What I want to walk you through is where we're headed, right? If all economies are ultimately just peaks and troughs, then what we're talking about here is, are we at the next peak? If 2006 was the last peak and 2009 was the last trough, then how do we operate in our new level of expansion, right? Every day you turn the TV on, CNBC, or Fox Business, they're talking about, well, 2020, 2019, on and on and on. When is it going to fall apart and what is it going to look like? So what I want to walk through are the three indicators that talk to you about how to invest in the late part of the economic cycle, the expansion part of the economic cycle. The first indicator of being in the late part of the economic cycle is liquidity. Right? Ultimately, all bull markets don't die of age. They die because there's no longer a buyer. The market heads down and no one decides to buy things at a discount. So what we want to watch, first of all, is the Federal Open Markets Committee. This is the Fed, right? When you turn on the TV and you hear the word the Fed, don't worry so much about it. It's not a big scary thing. It's just a group of people who have control of interest rates. And what they'll do with those interest rates is raise them or lower them based on what they see in the economy. In 2008, they decided to lower the interest rates to give us a break. But because the economy has gotten better, they're starting to raise them. So what you want to watch is the movement of the interest rates from the FMOC, the Federal Open Market Committee. The second indicator that we're watching to understand if we're in late stage or late cycle investing is the yield curve. The yield curve is the relationship between the 3-month and the 10-year treasury. This lets us know what's about to happen. If we look back at 2017, January 3rd, 2017 to be exact, you notice that the short term is low, the long term is higher. That means we make money for the longer that we wait. What investor would want to not make money if they waited longer? Nobody wants to do that. So what we see here is the yield curve is starting to flatten. And unfortunately, if the yield curve inverts, that means there's no money made for waiting longer. And the last 7 times that we saw a recession were preceded by an inversion in the yield curve. The third indicator of late stage or late cycle investing is earnings growth, and specifically the Standard & Poor's 500 large cap domestic equities. These companies let us know what's about to happen every quarter. They have to report their earnings. And when their earnings come in, we get to see what's going on coming next.